We've seen New Zealand shares weaken off over the last several weeks. Compared to the highs from September, the local market is down about 8%, which is a much sharper fall than what we've seen offshore, where the US and Australia have only fallen about 2%. There are three key reasons for this. For a start, the New Zealand market has been a very strong performer, rising more than 120% in the last 5 years and rising about 35% in the year to September. The second thing is that we've seen interest rates start to rise in some parts of the world. This has caused a bit of pressure on stocks that are high dividend payers, and we have a lot of those. The third and final impact has been that there have been a lot of offshore investors very active in many of our leaders over recent years, and these international investors have now started reallocating to other parts of the world. That's seen a lot of money flow out of the New Zealand market to elsewhere. The recent market weakness isn't causing us any huge concern. We still think the economy is in very, very good shape and growth is heading towards 4%. Tourism is very strong, the population is growing, construction is very strong, and the dairy sector has really turned a corner. If we think about some of the annual meetings we've seen lately with the likes of Auckland Airport, Port of Tauranga and Fletcher Building, most trading updates have been positive, which tells us that the corporate sector is in good shape. If anything, our market had got a little bit overstretched a few months ago, and this is a healthy pullback. On the global economic front this week, there will be advanced GDP reports from the United Kingdom and the United States for the September quarter. A lot of S&P 500 companies are reporting in the US, with the likes of Apple, Amazon and Google all scheduled to report results. Finally, there will be more AGMs on the local front, and this week we'll hear from the likes of MetLife Care and Meridian Energy.